Hello everyone and welcome to your weekly market update from Churchill Mortgage for Monday, January the 30th, where we give you the scoop on what happened in the markets that affects interest rates for our customers. Well, last week, like we mentioned, the markets responded sharply on Wednesday to comments made by the Federal Reserve that the rates at which they lend money to the banks will remain low through 2014. This was an inflationary signal for investors, and money flowed into the safer investment of bonds. Now let's look at the chart and track that movement. But first, let's review, especially for those, this is your first time catching our market update. You need to know that when you see these charts that we're charting the bond, not rates. And there's an opposite relationship between bonds and rates. When the bonds go up, rates come down. And when the bonds go down, rates are going up. So you want to keep that in mind while you're looking at these charts. Now, you can see on Wednesday, January 25th, where the bond took a big jump up and then it continued throughout the rest of the week until we hit Monday, where it definitely lost steam. What we want to see now is we want to show you what happened the last time rates hit these levels. The last time it spiked like that was around September of 2011. Hit the same level that it's at right now, but as soon as it hit that level, it took a big drop over about the next 20 or 30 days, and the bond dropped about 350 basis points, which equaled about 3/8 of a point in the rate. So we've seen that movement in the past. We're at that same spot now. What are the rate predictions across the country? Rate predictions from experts across the country are that our rates, 44% believe that our rates are going to go up. 31% believe rates are going to go down. 25% believe they'll be unchanged. Well, let's see what kind of news can move the markets for us this week. There are at least 10 reports out this week that could have a high impact on the markets, and that's a lot. Rarely do we see that many reports that can move the market, so this could be a very volatile week. On Tuesday morning, the employment cost index will be out. Employment cost index is kind of self-explanatory. It measures the cost of employment, employees, so higher costs would be lower profits for the companies. On Wednesday morning, the ISM, or the Institute of Supply Management report, will be out. All eyes are on that for the markets. That's a big indicator, and it's almost always moves the market one direction or the other. And then on Friday morning, the unemployment rate will come out. And obviously, all political and financial eyes are going to be on that report. High unemployment could signal bad news for the economy, which usually helps rates. Low unemployment is obviously going to have an opposite effect. So what should you do next? Well, if you've already applied, check in with your loan officer to see where rates are for your specific loan scenario. If you have not yet been approved for a refinance or a purchase, it may be wise to have that out of the way so you can act quickly if the rates make any drastic moves, or if you want to lock those rates in now. Are you not sure if refinancing is right for you? Get our free home loan report that'll compare your current loan against 3 options and how that'll benefit you over the next few years. And last, share. If you happen to know someone that could use this information, share this link with them or direct them to our site so they can find it as well. Well, that does it for our January 30th market update. Thank you so much for allowing us to serve you, and visit us on the web at www.churchillmortgage.com. Thank you.